I think maybe the key will be the breakdown of the dollar. I mean, the dollar index is barely holding on to a 100 handle. I think if the dollar cracks, let's say gets below 99, 99.50, then the dollar could drop very quickly to 90. And I think that move down in the dollar will send gold prices above 3,000 and silver prices above 50. We'll see. It could happen before the end of the year, depending on how it's timed. But I would think that if it doesn't happen this year, it's a Q1 2025 event. And I also think that's when the Fed is going to go back to quantitative easing. And of course, if gold hasn't already hit 3,000 on its own, a return to QE will do that. But if gold is above 3,000 and the Fed goes back to QE, well, then 4,000, 5,000. I mean, I think it's going to really start moving up.
The gold market has experienced a remarkable surge in 2024, hitting new record highs. The most substantial growth occurred in the third quarter, driven by rising geopolitical tensions and expectations of Federal Reserve rate cuts ahead of the U.S. presidential election, contributing to a weaker U.S. dollar. After over a decade of stabilizing following its dramatic climb from under $300 per ounce to around $1,900 in 2011, gold has now broken out of this consolidation, establishing firm support above $2,000 per ounce. Prominent gold advocate Peter Schiff has highlighted a significant influx of capital into the precious metals market, cautioning that investors waiting for a price dip may miss crucial opportunities. He points out that those who hesitated when gold peaked at $2,100 or $2,200, hoping for a retreat to $2,000, might find themselves sidelined as prices near $2,700, with the possibility of reaching $3,000. Meanwhile, silver is gaining attention as a compelling investment, recently achieving its highest weekly close in over a decade. It is priced below $32 per ounce and remains significantly lower than its historical highs of $50 from 1980 and 2011. Silver is regarded as undervalued when adjusted for inflation, and Schiff underscores its potential as an excellent buying opportunity. One of the main concerns is the escalating U.S. national debt, which is rising at a troubling pace. Annual deficits are projected to exceed $3 to $4 trillion, with an anticipated increase of an additional $25 trillion over the next 4 years. The national debt stands at approximately $36 trillion, and annual interest payments have already surpassed $1 trillion. Shortly, these interest obligations could outstrip the entire U.S. defense budget and even exceed major spending programs like Social Security and Medicare. In this context, gold is set to experience significant gains. Peter Schiff predicts its price could rise to $20,000 or even $40,000 per ounce, primarily due to the ongoing devaluation of the U.S. dollar rather than any intrinsic change in the metal itself. We will present clips from Peter Schiff's interview. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
If you just look at a nominal price, I mean, it's a massive breakout as far as any chart. We're in uncharted territory. But gold consolidated from 2011 to 2024. It went sideways, consolidating the big move from under 300 when this century began with gold at $270 an ounce. And so it went from 270 in January of 2001, it went to 1900 in 2011. So it had a 10-year move where it went up about sixfold. Then it went sideways for another dozen or so years before finally breaking out of that consolidation this year. And so we now have a base of support above 2,000, and money is just flowing in. And I've been telling, our customers at Schiff Gold all year, do not wait for a pullback. It's not worth it because the pullbacks are going to be too shallow to even make a difference. And while you're waiting for it, you're going to miss it because you're going to hope for a bigger pullback than the one you get. And then you're going to end up paying more. And we still have people that didn't want to buy at 2,100, 2,200 because they wanted to dip back down to 2,000. And now it's almost 2,700. And now, well, let me see if I can get a move to 2,500. And while they're waiting for that, it's going to hit 3,000. So I'm just telling people to buy. And of course, an even better buy is silver, which is still below $32 an ounce. You have a chart of silver. Silver double topped at 50. in 1980 and in 2011, and just nominally. I mean, silver is dirt cheap on an inflation-adjusted basis. So people should be buying up silver here. Don't wait for a pullback. It's already pulled back. You're getting a bargain at $32 silver. The national debt is growing at $3 to $4 trillion a year. I think the pace is going to increase during the next 4 years. We could easily add 25 trillion to the national debt. I mean, it's already 36 trillion. I mean, it's growing exponentially. Interest on the national debt is larger than defense. It's over $1 trillion a year. In a couple of years, interest on the national debt will be bigger than either Social Security or Medicare, and both of those expenses are growing. But probably by the end of whoever wins this presidential election, I think that interest on the debt will consume 100% of tax revenue. And so that means everything the government spends will have to be borrowed. And so there's no way that we can get there with the cooperation of creditors. I mean, there's a limit to how dumb the world is going to be to keep loaning money to a bankrupt nation that has no ability to pay it back and just think, well, they could print money, so we have nothing to worry about. That's exactly what they need to worry about, printing money into oblivion, where the money they print no longer has any value. That's the direction where we're heading. And so this whole thing is going to accelerate. That's why the price of gold, you talk about where it could go. It could go to 20,000. It could go to 40,000. I mean, gold prices can go up dramatically, but it's not that gold is actually changing.
No.
It's just when the country was formed in 1789, we ratified the Constitution and we passed the Coinage Act. We set the value of the dollar as a quantity of gold, and gold was $20 an ounce in 1789. When they created the Federal Reserve, in 1913, right, 120 some odd years later, the dollar, you still was $20 for an ounce of gold. So the dollar's value didn't change during those 120 years. And so you can still buy an ounce of gold for $20. That didn't change until the 30s after Roosevelt devalued the dollar. And then you needed $35 to buy an ounce of gold. And that held until 1970, or late 1960s, early 1970s. But when Nixon finally left the gold standard, the official price was about $42 an ounce. But now it's $26.60. Gold hasn't changed. An ounce of gold is still an ounce of gold. It's just that now you need 2,660 Federal Reserve notes to buy one, whereas you used to need 20 because of how much they've created. Well, that's going to keep happening. And, so who's to say that, you may need $20,000 to buy an ounce of gold soon?
While many analysts and investors view the U.S. economy as strong, concerns about a potential downturn are becoming increasingly prominent, especially with the 2024 presidential elections approaching. The Federal Reserve's recent consideration of interest rate cuts to address inflation raises significant concerns, hinting at a possible dollar crisis shortly. Peter Schiff warns that the economy may face a sharp recession rather than a gradual correction, largely due to the government's historical dependence on inflationary tactics during economic downturns. Schiff posits that easing monetary policies could exacerbate inflation, acting like a tax increase by diminishing consumers' purchasing power. This inflationary environment and rising living costs could create substantial hardships for everyday Americans. Additionally, Schiff notes a critical shift in the perception of the U.S. dollar. He suggests that instead of being viewed as a safe haven, the dollar may become a focal point of concern as investors withdraw from it. This mass exodus could trigger a crisis in U.S. sovereign debt, particularly as asset values decline and economic conditions deteriorate.
Right now, it's not that people aren't even noticing the price of gold going up. They don't even understand the significance from an economic perspective, because it's really proof that the Fed's policy is wrong. The Fed says, we were too tight, and now we're just, trying to normalize rates. They were never too tight. They were always too easy. And gold is proving that right now. But the other proof was the level of debt. If the Fed was ever tight, savings would have gone up. They wouldn't be record lows. Households wouldn't have record amounts of debt. The government would have cut back on spending if the Fed actually had tight money. But the Fed never achieved tight money. They backed away before money got tight because banks started to fail. And now they're loosening again with gold at a record high. And this is a huge warning sign. I've been pointing out that when Alan Greenspan was Fed chairman, 20 years ago, and he went before Congress and he was asked about, well, would we be better off on a gold standard? His answer was, well, we're kind of on a gold standard now, because he said, I use the price of gold to tell me if I've got the correct policy. So if gold is up around 400, I know that my policy is too easy and I got to hike rates. And if gold is below 300, then I know that I'm too tight and I got to cut rates. And of course, at the time he said that, gold was around 350. And so he thought, hey, I've got the policy about right because gold is in the middle of my range. Gold is at an all-time record high and goes up every day. So what is that telling you? Well, according to Greenspan, who used to be the Fed chairman, it tells you that interest rates are too low. Yet the Fed is lowering them more. We're going to have a hard landing. We're going to have a crash. It's not even going to be a landing, because what the government has done, what the Fed has done, every time we've had an economic downturn, they've basically come to the rescue by creating inflation. They print more money, they lower interest rates, and mortgage rates come down, people refinance, the stock market goes up because people are able to buy more stocks with lower rates, valuations go up. I mean, so they reflate a bubble. This time, it's not going to have that effect because we already have a big inflation problem that is going to be exacerbated by the easing of policy, and it's going to backfire. And so even though we're going into recession, long-term rates are going to rise, and that is going to worsen the severity of the recession. And the Fed is really going to be forced to raise interest rates if it wants to do the right thing, and the government is going to have to cut spending and maybe raise taxes during this recession, which they've never done. They always try to stimulate. They increase spending. They cut taxes. So they're going to have to do the opposite of everything they've done before, which in the short run, obviously, is going to make it a whole lot worse. I mean, in the long run, that's the right thing to do when you have a recession, is to cut back on government spending, and they have to let rates rise. But they're not going to do that. So that's why we're going to have a massive acceleration of inflation, which is actually going to worsen, again, the severity of the recession, because inflation acts like a tax increase. It destroys purchasing power. And so I don't think there's going to be any way out of this. I think it's just going to become, again, a dollar crisis and a sovereign debt crisis. And investors need to prepare for this in a way that, they've never probably prepared for anything in the past, because we haven't seen this. In the last few crises, the dollar is the safe haven. Everybody goes into the dollar when there's a problem. This time, the dollar is going to be the problem, and everybody is going to be fleeing it. And when you're fleeing the dollar, you're fleeing U.S. financial assets.
The ongoing battle against inflation appears far from over, especially with the Federal Reserve hinting at potential shifts in its monetary policy. This environment could lead to continued price increases, reinforcing the inverse relationship between the U.S. dollar and gold. As inflation rises and interest rates remain low, the dollar may weaken significantly, while gold will likely experience substantial gains. This shifting dynamic could have profound implications for investors, signaling a need for strategic adjustments as economic conditions evolve. Share your thoughts on Peter's analysis in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Until next time!